I'm joined by two of our distinguished East African Stock Exchange CEOs, as well as one of our own, Mr. Wale from Kuramo. And the purpose of this panel is to look at how we can make public markets work for private capital. We all know that we don't get enough public market exits as a means of creating liquidity for our industry. We would want more, but we are not seeing enough. Just some statistics from AVCA. According to the AVCA Performance Survey 2025, for exits in Africa last year, we had about 38% being trade buys of a total of 81 exits in the ecosystem. We had 26% of exits being secondaries, and just about 5% of the exits last year were actually IPOs. And so this panel is to try and find out, how do we grow that 5%? What are some of the structural gaps that limit this from happening, if any? And what are some of the things that we can do together with the RSC, the NSC, and other participants to increase the exits? And so, gentlemen, I would like to start with you, Pierre, just in terms of setting the scene. Do you think we have any structural gaps that hinder exits or creating liquidity through public markets, at least from where you sit, being in the RSC?
I think there is. There are so many, but they can be overcome.
Okay.
Some of them are about regulatory requirements we have, which can be a bit stringent to someone who's trying to exit an investment. So our requirements as exchanges can speak from the whole continent. As members of AVCA, that is our umbrella organization for the stock exchanges, we are trying to look at how we can address that. So the gap number one is stringent requirements, the turnaround time for IPOs and approvals from regulatory setup. The other would be liquidity in post-IPO. So that's one. That's the few that I can mention at the moment. So I think they can be overcome.
Thank you. We're hearing they can be overcome. And coming to you, Frank, the NSC has been quite vibrant this year. And one of the things we would like to ask you as my participants in the private markets is, what are some of the reforms you've taken up to ensure that the liquidity Pierre has mentioned is created within the Nairobi Securities Exchange, and give some level of comfort to the players in this room who are looking to exit, that at minimum we are able to generate the return, the cash that we promised our shareholders and investors?
Yeah. Thanks, Eva. Good to be here. Look, I think for me it starts with, you really cannot have very vibrant private markets if the public markets are also not vibrant. And in reality, it should be the case that GPs in, for example, private equity firms, when they are thinking about their setting up their funds, investing, value creating and exiting, that life cycle really also ought to factor public markets. Case in point, if your portfolio companies are looking to raise capital as part of your value creation process, you should also be thinking, how can those portfolio companies raise capital in the public markets, corporate bonds, commercial paper, etc. Similarly, at the exit point, as you look at the various options, exiting, for example, through IPOs on the public market should be a no-brainer. So the question becomes, why is that not happening, at least in our market, and what reforms are required to make that happen? The way we've looked at it is in three ways. The first one is to first have a vibrant market as is. So our listed instruments, our listed equities, and the complementary derivatives market need to be vibrant. And I'm happy to say at the NSC, that's the case. I mean, 2024, best performing exchange on the continent. 2025, second only to Egypt. This year, we are off to a fantastic run as well. So there's vibrancy in the market as we speak, which then makes it a viable option for yourselves in the private capital space to start looking at the exchange as a viable exit platform. The second thing we've looked at, and Pierre has touched on it, is relooking at our listing requirements. How do we make sure that once you decide that exit is an option and you start looking at the exchange as one of the ways to achieve that exit, that our listing requirements actually align with the same journey and the same heavy lifting you do if you're doing a trade sale or indeed exit into your secondary fund. So we have started having, actually we started last year having very, very detailed conversations with the East Africa PE and Venture Capital Association to look at what changes we need to make at the NSE to make listing easier, what policy and regulatory support we need to drive together in the market, and I'm happy to say that that is happening actually quite well. The second thing, of course, is all these valuations. There's no single time I've met any of you in the private capital conversation space, and we haven't had a conversation around valuations. The beauty is at the NSC, if you look at the trajectory since 2024 up until now, the price to earning valuations have actually improved. We are seeing that happening more pronounced in some sectors than others, in the 11 sectors that are listed at the exchange. But the point is the valuations are looking better and better. What we have chosen to do is to bring structured solution to it. So we are working with the sector to, for example, look at bringing to market a listed secondaries fund that will then be the exit point for just about all of you. So our view is we are part and parcel of the life cycle of making sure private capitals are successful, either supporting you during value creation and definitely being an option for you at the point of exit. And we have pipeline now of potential exit from your side, and hopefully you'll be seeing those happening definitely next month. We have 2 coming, and hopefully that will then open the door for many exits. But please consider the exchange as one of your options going forward.
Thank you, Frank, and I think that offers some level of comfort that you share our views in valuation preservation. And Wale, coming to you now as one who would be looked at for listing, how do you pick what is the best exit method for yourself?
Thank you, Eva. And I'm supposed to say it's good to be here. However, last year, I've been around AVCA for, I don't know, maybe close to 20 years. Last year, I spoke fireside chat, first day after keynote address. This year, I'm on the last day. I talked to Abby outside. She said, Wale, I have a new best friend, and it's now the Kuramo Foundation folks and everybody else, and they get speaking slots ahead of you. And so that is my situation. And then I'm here with regulators. I'm not quite a regulator as well, but Abby knows that we come from the same village, and Haddad and I are becoming new besties, so another report is coming to Haddad. And to your question, how and why do we choose? So we're about value creation, and we're looking for the best way to get value and liquidity to our investors. There's several ways to do that. Obviously, ahead of, when we're actually starting our thesis and our initial due diligence write-up, we earmark the avenues for value creation in a business, right? And it's the standard one. The listing is traditional, trade sales is next. Some kind of dividend recap, like people talked about earlier, is one. But we're looking for what's easiest, right, to do. Because we have several, you have to think about our lives, that we're raising money, we're investing, we're monitoring, and we want to get exits. So trying to find the easiest avenue for value creation is critical. Part of the challenges for listing is that, on average, it could take you 1 year to 2 years to get a company ready for listing. I mean, Pierre had this look on his face like maybe not quite in Kigali anymore. But I think generally by the time you go through all of the requirements that you guys have, I'm sure you have the SEC registration and all of that stuff too. It takes a long time. If I identify a buyer for a business that we own, it's not impossible that we close that deal from term sheet in 3 months. It can be aggressive. But there's no intermediary per se, right? So you can have a conversation with the buyer right away. So that's easier. And I think that's probably why we all kind of have that bias toward trade sales. However, though, and then the other thing which Frank touched on is the stock exchange itself. Because part of what happens is, you have your factors that are affecting the business, and then you have exogenous factors that are affecting the exchange itself, right? If it's a period where valuations are depressed, right, in general, you may not be interested in. So, like, I live in Lagos, and in Nigeria, the Nigerian Stock Exchange has been doing quite well, actually, also the last 3 years. But before then, though, the price to book on a number of our banks were below 1. And you knew they were doing much better than that. And so the question would be like, if you're in that market, do you want to go be part of that? And especially if you have other choices. So really, to your question, it's ease of access, liquidity, and speed, I guess, to liquidity is probably the most critical.
And right. I'd be curious to hear your responses on ease of access, Pierre and Frank. Is there a way you can meet us in the middle? Because it also does us good to list these assets, even in our follow-on fundraising. But if ease of access is a concern, and we all want path of least resistance, is there a way you can meet us in the middle?
Well, let me go first. I think Frank will compliment me. I think ease of access, by the time you get to the exit, you already know your valuations, right? Mm-hmm. So by the time you try to work on a transaction to come to market as an exit mechanism, which is what we are viewed for mostly as exchanges, you have an idea of what you are looking for. And we know the best pricing happens in exchanges, in the public in general. So, and what you are looking for is to exit, and the ease of access we are talking about is the turnaround between regulators and advisors and so on. So I think the ease of access can start early on, by talking to the advisory teams and talking to the exchanges and the regulators, and we are in between. Remember, at the end of the day, we are looking for business also. And the exit is a big one for us, and we are trying, all of us here, I think Frank can say that, can testify, we are all looking to lower requirements, not compromising on some good practices, but lowering the time it takes. I just heard about time it takes to get a company to market. I remember we processed an IPO in 4 weeks at one point in Rwanda. You understand? From the time you make the decision, the biggest challenge actually for us most of the time is the readiness of the companies. So now the advisory and the investors would be ready probably because the IPOs come around very rarely. So if there is one, people grab it. So we've never had any, even for a small market like Rwanda, we've never had any under-subscription. We always are oversubscribed in everything we are doing. So liquidity matters arise because of less, few products which are on the market. And I always say liquidity brings liquidity. So in a primary market, there is no issues of liquidity. So secondary market, the more products come on board, the more liquidity will come because the investors are diverse and they keep becoming more. We have savings that are increasing year on year, but they don't have products in the secondary market. So now, as regulators and market operators, we've been working very hard. I see my friends from the Kigali International Financial Center to ease access to anything, financial services, you name it, for people to be able to turn around whatever they want to turn around. And I think the ease of access should not be a question anymore.
Wale, how's 4 weeks for you?
4 weeks would be fantastic if if that works. I mean, I think obviously, I mean, the numbers I threw out were from the Nigerian Stock Exchange. They said 9 to 18 months, right? So, and they listed all the things you had to do, because part of it is the requirement. I don't know if you have the requirement. Like, you have to have an investor relations person, right, at a private company. Right? So typical private companies, the idea of having an investor relations company is extra unless you start getting yourself ready for listing. They required audited financials for at least IFRS audited financials for about 3 years or so. They required like dividends. You have to be paying dividends. Some private companies don't pay dividends at all, right? And so those are the reasons, and that's why I ended up with they ended up with a 9 to 18 months, and I said 1 to 2 years. But it sounds like, I mean, obviously Rwanda is always leading in terms of expediting stuff with your KIFC center. So if you guys have figured out how to do this in 4 weeks, maybe we all should start listing in Kigali.
Maybe I can give a small hint. I'm sure even Nairobi has some. For us, we also have a leeway to do waivers, and we are reasonable. So we try to reason with the case by case when things come. Because there's only 3 things you don't compromise about: good corporate governance, right, accountability, profitability. If there is no profitability, we can always look at it and see if you raise the money, maybe the money was the issue, or your gearing ratio was bad. So we look at those aspects, and if we see that something makes sense, there is no issue in you coming to the market, even if you are not fulfilling 1 or 2 requirements, because there is no one who can ever be perfect at the end of the day. And public markets, we should also understand that we are not perfect. And I think the same goes for Nairobi. But Frank is here, I can speak.
So for me, I think the first thing, Wale, is the Nigerian and West African companies should come list at the NSE. Because we cut through the red tape as far as listing is concerned. Why? In a market that is on your side, you're struggling with exits. That's the honest answer. I've seen the reports for both West Africa, East Africa. Look, the continent is struggling with exits. On our side, we're struggling with listings. So it's obvious that both of us have to find a middle ground somewhere. So for sure, from a Kenyan perspective, both from a policy, regulatory incentives, that we are working very closely with government to make sure we clear that. In fact, the workshops we've been doing in late 2024, early 2025, helped inform the policy requests that we put in with the government to enable us to have expedited, essentially, listings, IPOs, etc. And I agree, it's still not perfect. And to Pierre's point, because we are dealing with capital from the public space, particularly from retail investors, we do have to be careful how we curate any listing that comes to our market. But we are very actually open to exemptions, waivers, and things like this, of course, within reason. And I've seen the conversations that we've been having at the Africa Securities Exchange Association, that is, as the name suggests, an association of all exchanges across Africa, that the current president is actually Pierre here, that we are having a common conversation about making sure that we are not the bottleneck for listings coming to the market. In fact, if I compare the process, in the private space, you typically will source the potential buyer, they do the due diligence, you get into contracting, and I guess you get any approvals, complete the deal.
Right.
The flip side on our side is, first, you agree that you want to come to our market. Then we are talking about putting together your advisory teams, they put together the paperwork, the offering memorandums, etc., get regulatory approvals, which the exchange and the Capital Markets Authority in our instance supports, do the roadshows, come to market. That timeline usually can be toe-to-toe. It won't be 3 months, guaranteed. But typically it will be, maybe you're talking about 6 months. And by the way, depending on what option you're choosing to come to market with. Say, for example, if you're doing a restricted offer, that process, including the documentation, is even less than a trade sale.
Right.
If let's say you're doing a listing by introduction, so you're not raising any money from the public, through the exchange, but you're listing, you're coming to market. That's also a very compressed timeline. If you are thinking of listing, but not necessarily targeting retail investors,
Right.
the approvals and the waivers and the exemptions are even easier to get. Right. My view would be, actually the call to action, Madam Moderator, is we need to close the gap between what private capital and public markets, where we sit, are how we are thinking. We have a huge opportunity to actually enable your exits. And interestingly, most of the IPOs that have happened on our continent in the last 2-3 years have all been oversubscribed. So there's liquidity in the market. And you're struggling with exits. So we have this paradox of, money is sitting on one end, businesses struggling to exit sitting on the other end, and we are not talking. Well, I hope it is a conversation that moves beyond this panel. Right. We start talking deals, and we help you exit.
Yeah, I mean, look, there's no doubt that we need more collaboration.
Yep.
Because we're all part of the capital market system. I mean, while when we talk about exits, usually, I think there's always a strong focus on it. For us, it's value creation and liquidity, and we can get liquidity from our businesses several ways. Obviously, exit is just one of several ways you get liquidity. You can get it from dividend recaps, you can get it from revenue share, and a few other means. But the truth is, yes, we should figure a way where we sit down and we agree on how we get around some of these challenges that we think listing poses. I should say, though, even though I am saying this, that we still had one of the most successful listings of a private equity-led business in Aradel in Nigeria last year, which turned out to be a 3.4 times listing. I don't know if somebody from Cape Forward is in the room here, ACA. And then we're also expecting the big one that we're expecting this year is the Dangote refinery. Yes. And we think that will be a game changer as well.
And that leads me to my next question, which is, are there sectors that lend themselves more favorable to listings than others? Are we seeing, I think Mr. Aliko Dangote recently said he was looking to list his refineries across East and West Africa. Are there sectors you would prefer to see come to market faster? A lot of us have diversified portfolios. What are the sectors that you would say you'd prioritize, expedite, and give us priority support for?
That's the regulator.
Yes, the regulators.
Okay. Let me speak from at least the data we are seeing in terms of appetite. And let's assume that we are talking about businesses that are profitable, businesses that are well governed, and businesses that, of course, are let me say, well-known. In our market, we've seen quite a lot of preference for financial services. Banks, the banking sector has been doing very well. If anything, most of those counters have more buy orders than sell orders. We think that the population, by and large, understands the business model for banks. They also are comfortable that banks, first of all, are licensed, regulated businesses. They are used to disclosures. They have proper governance. So it's not a difficult sell. The second one is anything to do with telecoms and tech. And because in our market, those have proven to be fairly successful sectors. So there is definitely pent-up demand for well-run businesses in the tech and telecoms and technology space. If I look at some of the meetings that I have had from buy-side investors, particularly from European countries, asking about what else is in the pipeline, there is demand on energy, in the energy space. There's definitely, and that also has a lens around ESG and sustainability. these constant questions about value addition, businesses doing value addition to agricultural commodities. So by and large, I think for us, in Kenya, there's not much of mining and things, oil and gas and that sort of sector. So if I look at it, it seems to be pointing more towards services and probably tech. And I should also mention very quickly that just to support the exit conversation and link it to this question, Eva, last year we signed an agreement with an entity called Mobilist, Mobilist. It's a UK-funded program whose specific mandate is to support companies to list. And they support them in two major ways. One of them is to provide technical assistance support, including defraying some of the cost for bringing a transaction to market. So you're paying for your advisors, your structuring advice, etc. Number two is to anchor the listing when it comes to market. And they can anchor up to 25% of the total listing. So if you're bringing a $100 million transaction, 25 million is already taken up. And of course, that has a sector link to it. They are interested again in supporting sectors that have an economic impact. So infrastructure, power, financial inclusion, value addition, etc.
Right.
So I think the two are related, but I'm just trying to mention there are even actors that are there to support listings.
To support. Pierre, I don't know if you have anything else to add. Any unique sectors you're seeing in RSE that you'd prioritize?
I would say it's pretty much almost the same,
Okay.
because about 7 or 8 counters he has in Nairobi, we have them cross-listed, and we have similar institutions from domestic market which are equally listed. Maybe I could add also, we forgot maybe the C. They normally say the BBCs, so the cement companies, manufacturers also, who are doing things that are fast-moving. So I think that's where the Dangotes fall and the others that are coming in. So I think that's in general almost similar.
Got it.
What I could add is that these development partners, we also have a few like that who are supporting the markets at the primary level, where they are still in incubation style. Basically, we are doing the same for us to be accessing these companies to the markets. Yeah.
And with just about a minute to go, one of the things that I'd be remiss if I don't talk about is private equity fundraising in itself through the markets. We see it in developed markets where companies or funds, platforms will list and use that as an avenue to unlock capital. A lot of discussion has gone into African capital mobilization. We have a lot of our institutional investors asking to see a bit more of our assets and get familiar before they can invest. Wale, do you think there's an opportunity that we haven't tapped yet as an industry to raise money through that platform?
Yes, it's a tough one because some folks have attempted this in the past, which is to go to the market and raise capital and then invest after the fact in private businesses. So there was always that challenge in the mismatch in the sense that you're investing in private businesses but your entity, it's a listed one every day. So, the one group that tried it, called Atlas Mara here in Africa, I didn't quite work. Obviously, in the US, the big bulge funds, private equity funds, the Carlyles, the Blackstones, are listed. But I was on the President Obama's task force with one of the Carlyle guys, and he would complain to me about the market in Nigeria, and I would say to me, "Well, you're a long-term player, right? Because you invest in private equity." And it reminded me that that every quarter I have to issue a report because we're listed. So actually, the game there was actually not really about the business itself, but it was more about fundraising, right? because the revenue is tied to the AUM, right? Not to the performance of the underlying businesses. So it's a function of the underlying businesses have to do so well to encourage their AUMs every quarter to grow,
Got it.
right? So I think there's still a disconnect there. It sounds like it could be a great idea, but I'm not sure we've proven that yet.
All right, Pierre, and just mindful of
I see
time.
where we are on the clock. Maybe I wanted to challenge the group here. I think it's an excellent idea. You see, there's a fallacy I kind of see most of the time, and I've discussed it with people in the industry. Most often we talk about private equity, but the private equity is using public money, right? So how private is that? If you are raising money from a social security fund, a sovereign fund, or an insurance company to form your own private equity fund, how is does that make it private, really? You understand? So now, if you go a notch further, you go to the public markets, you are still tapping up the same people who are also collecting public money. If you are a pension fund, you are getting money from what? From retail people.
Yeah.
Right? Their salaries and so on. So what I'm trying to say is there is an opportunity, but also tapping that can tap into the retail investors eventually and correct investment schemes here and there by embracing the public markets. There is a success story I think I can mention here.
Yeah.
Maybe you can Google a company called RH Pofelo. They are in health sector in South Africa. It's a company that started in private markets like that, and they raised money and they listed the company on the Joburg Stock Exchange, and they are cross-listed in Rwanda. So their thing is they are touching and I wouldn't say unbanked, people who are not underserved communities in South Africa, and they are in healthcare and they are listed. So there could be others in other markets that I don't know of, but the idea is good.
All right. Monica says that to wrap up, but maybe I can get a final shot from everyone in less than 30 seconds.
All right. So, I mean, look, like I said earlier, we're all part of the same ecosystem.
Yeah.
And so we all need to figure out a way to work together to get to the same goal.
Thank you.
I would agree with Wale. My view is that to complete the life cycle, once you get into the deal, the value creation phase, you should consider the exchange because your portfolio companies need funding. Corporate bonds, commercial paper come to us. At the exit stage, we are your true partners because this is a market that is untapped.
Thank you. Yeah.
I would combine the two. I think we all need to work together, which brings in play the new NAFA. They added a D recently, FDB, this new idea of the new African financial architecture.
Yeah.
It's only talking about us working together. We are not competitors, we can complement each other. Number two, as markets, we are not only exits. I think we should also try to go into working with the companies themselves at the early stage and the VCs and everyone who's involved in that ecosystem so that we narrow the exit if they want to exit, or we can support the whole ecosystem together. Thank you.
Thank you so much. And as I wrap up, I will say it takes a village, and this is the village.
Thank you.